All right, everybody. Thank you for coming today. Today, we're talking about alternative loan products. And so I wanted to kind of step back first and talk about what traditional loan products are so that then we can kind of get more information, more in depth into what a non-traditional loan product was. So let's start by just defining what a traditional loan product is. We've heard these names before. We know what they are. FHA, VA, conventional, USDA. These are all traditional lending products. Probably see them on most of our loan applications. We probably see them most of the time on purchase agreements. It's kind of the standard loan that we're seeing. We've done classes on these. There's a lot of great information if you check back on YouTube. So these loans are set up that have guidelines that were created by Fannie Mae and Freddie Mac. And so their guidelines are created primarily to make sure that a borrower or buyer has the ability to repay. So we look at things to qualify them based on that information. So we look at income. We got to make sure they have pay stubs, W-2s, tax returns, all of the information to qualify them for the loan. And then we use the debt to income ratio to make sure that their liabilities don't exceed how much money that they have coming in. So that's kind of fits in the box of Fannie and Freddie. So these are easily packaged, they're resold, they're used as a commodity, basically being bought and sold as an investment tool for people. So that's what a traditional loan is, a traditional loan product. Now, if we take a look at what a non-traditional loan product is, it's really anything that doesn't fit right within inside of that box. So, we talked about income, debt to income ratio, W-2s, tax returns, all of these things qualify a borrower. So anything that is not included within that box would be an alternative loan product. So we'll get into some detail about what type of loans qualify as an alternative loan product. But again, anything outside of that box is what we're talking about today. So why would anybody want to use a non-traditional loan product or an alternative loan product? Well, it's anybody really who doesn't fit within that box that Fannie and Freddie have created. So maybe they're a self-employed borrower. Maybe they're a 1099 employee, so they're a contract worker. Maybe they're an investor and they're buying an investment property. All of these loans are used to fill that void that Fannie and Freddie have created. So they created that box, and there's all these other borrowers out there who are looking for opportunities to buy. One of the things that I noticed when I came to Montana is that a lot of people fall outside of the box that Fannie and Freddie have created. So there's a lot of people that are self-employed. There's a lot of people that are seasonal workers. All of these things, there are a lot of investors or maybe retirees. So a lot of people fit outside of the box that Fannie and Freddie have created. And these loan products are really designed to fill the void and capture those people so they're able to get a loan. I'm going to go through some of those loan products now and kind of explain what they are, how you qualify for those products, and what they can be used for. So I'm going to start with something called a DSCR loan. So you've probably seen the acronym, or it's an acronym, but it's Debt Service Coverage Ratio, DSCR. So this is an investment loan product. It's not used for a primary residence. It's only used for investment property. It can be 1 to 4 units. Beyond 4 units, you're looking at some type of a commercial loan, but anything between 1 and 4 units, duplexes, fourplexes, triplexes, all of those things fit within this category. Now, the great thing about this product is that we're not qualifying the borrower for the loan. We're really qualifying the property for the loan. And so I talked about a ratio, debt service coverage ratio. So it's simple math. It's basically how much can a property create in income versus how much the cost of all of the debt is on the property. So how do we get to that number? It's pretty simple. Standard appraisal happens because we got to make sure that the value is equal to what the property is being sold for. But we also do a rental appraisal. So an appraiser is going to go out and look for comps on similar properties that are within the same area as this rental. And so that's the traditional way how you qualify for how much income you can create versus how much debt. So if there are existing leases on a property, they always take the lower of the two numbers. So if the leases are really low, but the appraisal comes in really high, we're still going to take the low number. So it's one of those parts of the debt service coverage ratio. You want to see at least a 1-to-1, and the debt is everything: principal, interest, taxes, and insurance, all of the things to run that property. So one of the important tools about this product is the more down payment you can bring in, the easier it is to qualify on that debt service coverage ratio. Zach talked about this a little bit last week on construction loans, is that the more money that you can put in as a down payment, the more flexibility you have. The less down payment you have, the less flexibility you have. And this absolutely runs true with all of these loans that we're talking about today. So another product I will talk about is called a bank statement loan. So a bank statement loan is exactly what it sounds like. So rather than W-2 income or tax returns, we are looking at bank statements to figure out what your income is. Now, who uses this kind of a product? This is somebody who's self-employed. Typically, they need to be self-employed for 2 years, and that business needs to have been in place for 2 years. And these are people that are probably taking advantage of all the rules that are set out in our tax code to limit their liability on taxes. So potentially on their tax return, they may show very little income. But if we look at their bank statements, we know that there's a lot of money coming in. So how do we qualify their income? We take 12 or 24 months of business or personal bank statements. We add all the deposits together, divide it by 12. That's our income. Let me step back a little bit. We take that number, divide it by 12, and then there's a cost associated, how much it costs to run that business. Maybe it's 50%. Maybe it's for if they have fewer employees or no employees, then maybe it's a 10%. So we take off a certain amount depending on the business, and then that number is our monthly income. And that's what we then use to create a debt to income ratio. We look at other liabilities, just like a traditional loan. So rather than using their W-2 income or tax returns to figure out what their income is, we're using bank statements to figure that out. It's a really great tool for those self-employed borrowers who, or even, people who maybe are in the ranching industry and they make a lot of money one time a year and don't show much income the rest of the year. All of these are great opportunities to create more borrowers and more buyers with this tool. So bank statement loans. Let's look at asset loans. Asset loans are great for people who have probably retired or just have a lot of money, but don't necessarily have a job. So we're not looking at tax returns. We're not looking at W-2s. We're not looking at pay stubs. What we're looking at is the liquid assets that they have available to them. And so to figure out if they can qualify for this loan, it's really simple math again. We look at all of their liabilities, so mortgage statements, everything that they have, and they need to have 60 months or 5 years of liquid assets available to them to then qualify. Typically, something like this does have an additional requirement for reserves, but this is a product for somebody who no longer working, they're ready to maybe potentially buy a second home. They've got a lot of liquid assets, and they're looking to utilize that rather than traditional income. 1099 borrowers is the next one. So 1099 borrowers, there's a lot of gig workers now. There's a lot more than there used to be, and we're seeing these more and more often. So a 1099 is a contractor, basically a contractor who gets paid by one business. And that one business, they need to be getting a 1099 from them for at least 2 years. And then we're not looking at tax returns, because once we look at tax returns, you're looking at all of the write-offs that they have. So their tax returns probably don't show a lot of income, but their 1099 shows good income. It's a great tool for those gig workers, as long as they're consistent with one employer. They could have multiple 1099s, but we're only going to be able to use one at a time for one employer. The last one I want to talk about is kind of a newer product. It's called a bank statement second. So this falls, for multiple reasons, falls outside the traditional Fannie and Freddie. First of all, it's a second mortgage, so that kind of falls outside of the box. And then we're using bank statements to qualify for the borrower. Now, we all know that there's a lot of equity built up into properties, and people have gotten incredible interest rates over the last couple of years. And so there may be some hesitancy to do a full refinance. Now, this is a great way to take the equity out of their house, use it for improvements, paying down their debt, whatever it is, as a second mortgage, and keep their first mortgage in place. There's a couple different options on these. There's, an open-ended HELOC where there's a draw period, 5 years potentially. And then there's an amortization period where you're paying off that loan over 20 years. And then there's something called a HE loan, which is you're getting a lump sum up front, the end of the loan, a lump sum up front, and then you're paying off, that's amortizing immediately over 20 or 30 years. So these are great tools to help alternative borrowers access some of that equity that they have sitting in that property. Let's talk about what some of the drawbacks are to these loans. Now, these loans, because they're outside of the guidelines that Fannie and Freddie have set up, a lot of times there's additional guidelines that the lender has created to make sure they fit within their own smaller box. And so typically there's initially there is going to be an increase in interest rate over a traditional loan. So maybe it's a point, maybe it's a little bit higher, but these are higher interest loans because they are seen as slightly higher risk. And so investors on higher risk loans expect to see more of a return on it. So that's one of the drawbacks to these. There can also be additional guidelines that don't allow for certain properties. So a lot of these have lot limit maximums, whereas you could get an FHA loan that could be a large piece of land, or a USDA loan, or a conventional loan. But a lot of these are typically not designed for unique properties, let's call it that. And in Montana, we do have a lot of unique properties. So why is that important to know? I mean, really, it's important to know because your lender, your broker, needs to have all the information about that property so that they can make sure that not only does the borrower qualify to repay that loan, but that the property qualifies to get a loan placed on it. So it's really important if you're in one of these transactions that your lender, us, are really going over the guidelines and understanding what the property is and what it's not. So, I mean, those are the basics of what what alternative lending is. I'm a little short on time. I think I spoke faster than I wanted to. So I'm gonna see if anybody has any questions. I know Zach's got one. He always does.
I don't have any questions, Tyler, because that was such an excellent presentation. You
Oh,
nailed it.
oh, please. Anybody got something for me? I'll just finish by saying a couple things that I know that I skipped. So all of these loans are going to have some guidelines that are similar to Fannie and Freddie, whether it's debt to income ratio, loan to value, all of these kind of still, not all of them, some of them still have those guidelines. So a bank statement loan still has a debt to income ratio, whereas a DSCR or an asset loan does not have that. A 1099, it's going to have a debt to income ratio. So all of these products, we're going to pull credit. We need to have, for the most part, higher credit scores than maybe an FHA or a VA loan. It's really important that people understand that these are not a get out of free jail free card for not filing your taxes. They still need to fit within the parameters of the guidelines that have been set up. And so it's going to take work on the front end as loan originators to really help qualify the borrower and make sure that we have all of our ducks in a row, because we still have to hit a lot of those guidelines and expectations on a traditional loan. And so these aren't necessarily easier or harder. They do take some time, and they take work on the loan officer's part to make sure that they are a working loan.
Hey, Tyler.
Yes, Dave.
You might have covered this because I was multitasking, but I'm going to throw it out there.
Yeah.
So I sell these too, obviously, because part of Black Diamond Mortgage. But one thing I was thinking is important to know, and maybe you could talk about it if you didn't, is I think the borrower for these products is in two categories. One, this situation is temporary.
Sure.
Or it cash flows and it doesn't matter. But maybe you could just talk about those being like the two best users of the product, or tell me that you already said that and I'm an idiot.
No, I think that's a great point. And so an investor loan, a DSCR loan, is typically always going to have a higher interest rate, but the point of it is that it is going to cash flow. It has to qualify in that way to make sure that it's an actual loan. And so in that regard, it doesn't really matter. But as if it's a bank statement loan, that's something that's remedied. We can remedy that. And you remedy that as a self-employed borrower by filing your taxes and paying more tax for a year or two, so that then we can qualify you as into a traditional loan. And so, yes, you're right. These are, I don't know, you probably know this more than me. Have you ever seen anybody in a bank statement loan for 15 years? They probably haven't been around for 15 years. I mean, this is
funny you should mention that. So I would say most people should take those kind of loans as a temporary, 1 to 3 year. But we have a client that owns a bar, and he cash flows crazy through the bar. And he
Gotcha.
comes back every once in a while to see if he can get into a traditional mortgage, and he never can. But it's a good loan for him because he doesn't want to document enough income for taxes. And he actually got the loan a couple of years ago when the rates were lower. So even though it was higher back then, the rate now is actually pretty good for what the market is. So I would say there are some people who take bank statement loans where, you know, it works for them. And I guess that would fall under the it cash flows category. Sure. But he always wants to do better. And he's like, yeah, I'm going to file better taxes someday. But in all honesty, he never does. And he's doing just fine.
Who do you want to pay? You know, some people aren't interested in paying Uncle Sam. They want to, you know, they'd rather pay a lender. And so there is a trade-off. There always is a trade-off in life, right? Yeah. You can do things that they set up the rules for. You can, and reap the rewards of that, or you can take a step back and decide you want to do it a different way. But there are consequences for that as well. The great thing about these products is that the consequences don't have to keep you from owning a property, right? All right, any other questions? All right, speak now or forever hold your peace. Okay, I think we're done. Thanks, everybody.